Next is Chris. So Chris is a CFA, charter holder. I am too, and it means he's very, very strong credentials in investments. He's a senior manager in Vanguard's Investment Advisor Research Center, creating thought leadership in the areas of investment, wealth management, and behavioral coaching. Prior to his current role, he was a senior investment strategist in Vanguard Investment Strategy Group, where he led the team that conducts research and provides thought leadership on issues related to alternative investments, active management investments, and investor behavior. Frequent speaker at industry conferences, has published white papers on a variety of investment-related topics. He has a BS in accounting from the University of Delaware. As I said, he's a CFA charter holder. And also, you're a CPA, also a certified public accountant, as an investment committee board member at the Chester County Community Foundation and past president of the CFA Society of Philadelphia. Chris, I'm going to welcome you up. Please welcome him, and he's going to talk about ignoring the noise, the value of your advisor. Please welcome Chris Tidmore.
All right. Well, thank you, everybody, for having me. Thank you, Leonard, for the kind introduction. When I hear the resume and stuff, I feel like I'm just old, more than anything else. I think a little bit more, I'm sure many of you are familiar with Vanguard, a little bit more about Vanguard. Vanguard's mission is to take a stand for all investors, treat them fairly, and give them the best chance for investment success. Right? It's why I joined Vanguard 9 years ago or so, really because of that mission. What we also believe firmly is that one of the best ways to achieve that mission is through working with advisors. We've been working with advisors for 20 plus years or so. About 3 years ago, we created a group where our sole focus of research is on the advisor community. And how do we do that? We do that by partnering with advisors, hearing their concerns and issues. It can be everything from wealth management topics, financial planning, tax planning, portfolio construction, how to coach your clients, how to grow your practice. And what do? We produce advisor-friendly research. What I mean by that is you don't have to be a PhD to read it or understand it. And even more and more, we're helping advisors after they think about the pros and cons of decisions they might be making, how to then talk to their clients about that, how to provide content that might be useful for their clients. Why do we do that? We believe that it improves client outcomes, which of course then ties back to our mission. And that's the goal and objective. Now, clients, of course, have big goals and objectives. Client outcomes are best achieved through those goals. And most people have a whole series of different goals. It can be everything from when they're younger, saving for retirement, putting their kids through college, when they're in retirement, making sure they don't run out of money. How are they best going to transfer wealth to the next generation, donate to charity? All those type things come along with that. Now, some people choose to invest and do this on their own. A lot of people use an advisor. What we found in our research is those who use an advisor are highly tied to people's age. About 10 years before retirement is usually when they realize, oh my gosh, I need an advisor. Wealth and the complexity of their financial situation. Those are usually the biggest drivers of when people need an advisor. Now, people also have a lot of investment concerns, right? And investor concerns. Some of these you can plan for better than others. What we say is some are important to focus on, others are important to ignore, like a lot of the things that were in the poll, right? As far as from a financial situation, what we like to say is there's a lot of things out there that may affect you personally, right? But they don't affect your portfolio, or that they are very difficult to figure out how it will affect your portfolio. An advisor helps you on an ongoing basis. Obviously, the first thing that they do, right, is figure out what your goals and objectives, what your values are, what you want those to be, a prioritization of your goals. They develop a financial plan. I don't really like the direction of the arrows, but they develop a financial plan. I'd go the other direction. Figure out then that investment portfolio that best gives you the highest probability of achieving your goals, and what we call is the required returns to achieve your goals. And then ongoing advice. And that ongoing advice, right? Some of the things you can experience it as an advisor and deal with proactively. Other things you're going to need, the advisor will need to be reactive. And the biggest reason the election, there were a lot of questions about that. The things that an advisor can be proactive, your portfolio will be volatile. There will be things that will go on in the markets geopolitically that you need to ignore. There will be a worry about things that are going to happen in the future. All of those things, the advisor's job is to proactively help you ignore those things, right? The other things, unfortunate things in life, will be things that need to be more reactive. And that's where the focus of the advisor is. Things that happen, death, divorce, unforeseen job losses, unforeseen interruptions in business. Those are the things that the advisor really can't really prepare for that well and will need to be more reactive in nature. Now, why do people hire an advisor? It usually fits into some combination of these three things. People either don't have the time to do it, the willingness, or the ability to do it on their own. Any of you handy around the house? Okay. I see some big hands in the back going up. I'm reasonably handy around the house, and deciding whether or not to hire someone to do things around the house really fits into these three things, right? I love mowing the lawn. I travel a lot, so I don't have the time to do it. We have the same thing as you. We have no water. Hasn't rained in forever at home. So mowing the lawn, I pay someone to do that because I don't have the time to do it. Some things fit into the willingness. I work part-time in college as a painter. I hate painting now. So unless my wife's willing to do it or one of my kids, I pay someone to do it. And then, of course, a lot of things fit into the ability. When I got here 2 days ago, my wife called me and said, our furnace needs to be replaced. I cannot go home and do that this weekend. So some things fit into the ability. Where these all tie to, and our research, as it said about 20 plus years ago, we've been working with advisors. We put out research about early 2000s that really was called Advisors Alpha. And what that meant was just the value of an advisor. And really what it said was the value of an advisor either was or could be more than just picking stocks or bonds. That the most important things an advisor could be doing, or what we're doing, back then it was really stockbrokers picking stocks and bonds, were the things that were more important for clients achieving their goals. Now, this is the part that these guys are going to like that I tell you is we put all these pieces together of the different things that they do. And about 10 years later, we went and we quantified that. We basically said, what is the value of an advisor doing all these things correctly relative to the average investor out there? Not the worst investor, the average investor doing these things on their own. And we come to a number that hasn't changed that much, of about 3% a year. Right? Some of the things are really easy, much easier to quantify, and the advisor can tell you this is the value I'm adding by proper asset location or proper drawdown in retirement, those type things. What we also find, though, is the biggest piece of that, and it hasn't changed that much, is the coaching that they do to help you stay the course and ignore the noise, like the election in 2 weeks. Right? Now, your advisor group, and they didn't pay me to come up here and say this, your advisors can't turn around and tell you, I've coached you along to stay the course, and that's the value that I'm giving to you. The other things they may be able to say, but really in our research was moving from something about, hey, I'm going to outperform the market. That's easy for an advisor to say they're doing. Very, very difficult to persistently do. Okay. So what we see, though, is one of the most underappreciated. There we go. Made it go away. I was lucky there. One of the most important things, or most underappreciated, the reason that you hire an advisor is you guys are all overwhelmed with data and information and understanding what to do with it. Now, the punchline is, as I've said, ignore most of it. What a lot of people don't understand, even a lot of people who are investment professionals, is that the market is continuously taking into account what everyone thinks in aggregate is going to happen on a forward-looking basis. The probability of all the different things that might happen. And the prices that are currently in existence of all the securities relative to one another, all the different types of investments, takes all of that into consideration. So if for any issue or event that you are thinking about trying to make an adjustment to your portfolio based on what you might think will happen, you got to understand, is your thought different than the market? And there's two questions that you got to ask. First of all, does it matter? And then, is it knowable or predictable? So first of all, does it matter? If you're saving for next generation wealth or not to run out of money 20 years, or you're younger and you're saving for retirement, or you're saving for your kids' college, what the Fed does, the war in Ukraine, Israel, the election, have almost no impact at all on your portfolio. Even if they do, the other part you have to get right is it knowable or predictable. So knowable, what actually will happen, right? So I saw some of the things up there, some of the things you guys did very well last year, right? And it was even knowable. The problem is, what was the impact on the market? You guys were really bad at that, right? The market was up considerably more than 10%. No one thought it. And I will tell you, if you look back a year ago at the forecast of 75 different, the top end forecasters, all the big firms that were out there, 1 out of 75 so far at this point has gotten it right, right? 74 of them got it wrong. So you guys are about the same as they are from that perspective, right? Now, there's a lot of noise out there. And I think the most important thing is there's never an all clear sign in the market, ever. The only time you know it's an all clear sign is after that's passed, right? And there's then something else to worry about. So a great example of this is COVID, right? See the drop down in the market and then the rise afterwards. It affected billions of people personally, their lives, what they did for their lives. The impact on the market in your portfolio lasted about 3 weeks, right? I had even a conversation yesterday with an advisor who had a client, had upwards of 8 figures in their portfolio, and they had to fire their client because they could not keep their client from selling everything in their portfolio and going all to cash in the portfolio. So that's the part where I say the coaching part, the ability to keep your client invested during that time. Clearly, they didn't do a good job with that. But that is the end goal. At the end of the day, what you hear there is, I'm going to go to cash. I'm going to wait till a vaccine comes out. I'm going to wait till things go back to normal. The market, remember, is always forward-looking. So they're anticipating how bad things will be, weighing the probabilities, and it clearly would have been a very bad mistake. And there's hundreds and hundreds of examples of these type things. For the election, I definitely said I'd talk about it a little bit. What we've seen through time, you look back over the last 100 years, the market continues to grow no matter who's in office. It may affect you personally, but it rarely ever affects your portfolio. We've looked back at all the 4-year administrations. I know some were more than one 4-year. Over the last 100 years, only one time did a 60-40 actually have negative returns. It was 1932 to 1936, right? It just has not. Think of all the crazy stuff that's happened between the 1930s and now, and you've not had one negative 60-40 portfolio over a 4-year administration. All the good and bad presidents that have come and gone, but depending on where you lean. Now, reason why we don't want to time the markets. What you're seeing here is, if you had on the left side, if you had $100,000 you put in the U.S. stock market in 1988, and you stayed invested through 2023, you had $4 million, right? Now, what we can do is I can go back and look at every single day over the last 35 years. It's about 252 days in the year. So you're talking, 9,000 or so days. And I were to remove the 10 best days in the market. Instead of $4 million, if you weren't invested, you'd have $1.7 million. If you missed the 20 best days, you have $1 million. You miss the 30 best days, you have $700,000 instead of $4 million. I could also show you the opposite, which is the part that probably matters. You want to ask your advisor, why can't we miss the 10 worst days? I think they're coming up with the election, right? So I want to get out of the market. If you miss those, and this is the reason why you ask your advisors about this, there's an opposite sign. You miss the 10 worst days, you have like $7 million. You miss the 20 worst days, you have 8.5 million, and so on. The problem is they cluster together. So this is just showing about, what do we do this, over 3 years, 3.5 years. The up and down days tend to come really close to one another. And what you tend to see is on a downward trend in the market. Let's take the financial crisis. Fourth quarter of 2008, 3 of the best days ever in the market took place in the fourth quarter of 2008, even though like 5 of the worst days took place. It was just a few more bad days than good days. When you go to the first quarter of 2009, you got the opposite. You had 2 or 3 of the worst days, but you had 5 or 6 of the best days, and they clustered right next to one another. And we'll ignore the tax part of it, but no one out there has the ability to time the ins and outs during that time period. Right? Now, trying to time the market leads to people chasing performance, right? And what does that look like? What I have here is it's basically the performance of people's money and funds relative to the performance of the funds. What we see people do is, hey, this has recently been doing well, let's buy it. This has recently been doing poorly, let's get out of it, right? And why do people do that? Why? Because it works in almost everything else you do in life, right? You own a business. I own, 2 restaurants. This one's been doing well, this one's not been doing well. We do different things in the 2. Why don't we start doing what's working well in the one restaurant, in the other, that's usually successful, or let's expand this business, or this line of our products that we offer, people are buying, so let's put more money behind that. Those type things is what works in most of the rest of life. It just doesn't work in the investment world. And I'll get to talking about why in a second. So for you guys, think about a typical decision you make. Anyone by chance, let's say, I know only because it came up late, was a question. Anyone bought a car lately? Right? See a couple people raise their hand. Think about when you go to make a purchase decision. It's usually, I have a need recognition, collect information, word of mouth. Maybe you had the car before and you liked it, warranty, safety rating, how it's rated by, Consumer Reports, friends, family, whatever it might be. You collect all that information, you evaluate the information, you make a decision. The most important thing is what happens next. At some point in the future, you evaluate your decision and you say, 6 months later, this is a good decision. I like my car, right? For these guys, we decided to have the meeting here, right? Because it went well last year. It went well again this year, or stay at a hotel. I looked at the ratings. It looked good. It ends up being, we had a positive event. And we've done a bunch of research on this to show that it's true. So for what you see here, these are restaurants. It's Michelin star ratings by the critics. So on the left-hand side is 0, not rated, to 3. Those are for anyone who doesn't know, that's critics' best ratings. And then what do people do? They listen to those ratings, and then they go eat at the restaurants. And then they give their Yelp reviews. And what do you see? The higher the ratings by the critics, the more they're liked by the people who eat at them. And we see this when we look at universities, when we look at hotels, pretty much across the board. The only thing I ever joke around that doesn't apply to this, besides investments, which I'll get to, is golf clubs. Right? You go try a golf club out, it works really great, you get the proper grip, and then you go use them and they stop working. But on a more serious note, we even see, and we didn't do this research, but it's someone's research, any doctors, ex-doctors, medical professionals, what it is we looked at measures of technical skill, so prior complications, and then how many forward-looking complications that they had. The more technical skill that they had, the less complications, less death, less morbidity. So we're essentially trained to think this way. And the question is why? Go way back. Early caveman days. 2 groups of cavemen, they're all thirsty. One group drinks from running water, one drinks from stagnant water. Who gets sick? Those who probably drank from the stagnant water, most likely. So what do they learn? Hey, stop drinking from stagnant water, keep drinking from running water, and I don't get sick. And that same thing carries, as I said, for most things in life. So what do we see happen? We see that people do this same thing in the investment world. So what you're seeing here is 1 year, 2 year, and 3 year performance, cash flows into the dark green color is the best performing funds. So all the money goes into the best performers. On the right-hand side are the worst performers over the prior 1, 2, and 3 years into those. This is what we'd expect. It's the right mindset. This is where, if you ever hear the negative things of investors shoot themselves in the foot, they're their own worst enemies, all those type things. No, they're not. They're just doing what worked. You guys are all, if you ever have that pressure to do it, or you put pressure on your advisor to do it, right? You're just doing what naturally has worked in everything else that you do. Right? Unfortunately, I'll go back to this. So if I looked at the 3 year and I look at all the cash flows into the best performing funds, and those best performing funds, so that best quartile funds, we're going to do best on the next 3 years, I should see 100% of those funds being the top quartile again. Persistence of outperformance is what we call it. Unfortunately, on the left is the amount that actually stay in the top quartile. So there's 1 3 year period and then looking at the next, right? It's about 25%. Randomness, complete and utter randomness would be 25% in each one of these buckets, right? You would have, hey, this fund was a top performer. The next time period, kind of rolling the dice, 25% stay as a top performer, 25% in the next bucket, and 25% kind of as an underperformer. Now, having been an ex-active manager, I'd like to think that I had some talent and skill, right? What it really means is there's a concept known as the paradox of skill. By any chance, is anyone familiar with it? Okay. So the paradox of skill applies to games, and games that are a mix of skill and luck, and that have rules. A good example of this is chess. Chess has very clearly defined rules. Luck plays no part whatsoever, right? And so skill is all that matters. So Bob, if you are a grandmaster in chess and I'm halfway decent in chess and we play 100 times, you're still going to beat me 100 times out of 100. The opposite side of that is a game with rules where luck plays 100% of the part. Right? I have a 3-year-old niece. We played the game of war over the summer. She beat me about 50% of the time, right? Because anyone remembers, you flip over the cards, whichever one's the highest wins. If there's a tie, put more cards down, etc. So that's those are the two extremes. Most things fall in the middle. So when they fall in the middle, what ends up happening as people's skill increases, right? The absolute skill of the participants increases, but the relative difference in skill shrinks. And the more luck is involved, people don't persistently outperform or win. A great example of this, and anyone ever watch little kids play soccer? Right? What happens with little kids when they play soccer? They all chase the ball around, both teams. Maybe the goalies stand in the goal, but besides that, they all chase the ball. Absolute skill is not very good, right? And then what happens? Eventually that one kid realizes, well, if I step away from this giant scrum of kids chasing the ball comes to me, and that kid will score 3 or 4 goals in a game. That kid's absolute skill is not very good, but the relative skill relative to the competition is quite good. Now, fast forward, we get to the professional ranks. Absolute skill is much better, but the relative difference in skill between one player and another is not all that much, right? And so even the best players in the world, like say a Messi, it's great when he scores a goal every other game or so versus scoring that. Now I know every once in a while he does score 3 goals in a game, but the relative difference isn't all that much, right? So it does not mean that it doesn't mean that you won't see talent show up over long periods of time. The more luck is a part of it, but over short periods of time, you cannot expect persistent outperformance in the marketplace, right? Now, related to that, right? Always pressure to make changes to the portfolio, right? Have any of you guys, this is audience participation and be honest, anyone ever called their advisor to ask either, are you going to make a change or why didn't you make a change to the portfolio? You guys are good. You've coached them well. Yes. We go through this all the time. And so it's back to my original thing of like, does it affect and is it knowable? In order to get a decision right when you're adjusting your portfolio, you have to get all four of these right. What is the signal? So either what's happening right now or what do you think is going to happen in the future? What's the trade? What are you going to do? What are you going to sell out of or buy? And what are you going to do then with that money? Or where's it going to come from? How big of a bet are you going to make? How long are you going to hold it? Let's say it starts working for you, right? Are you going to get out of it? I'll give a great one for me. Years and years ago, I loved Apple. I thought it was poorly run. Steve Jobs got hired back by Apple. I bought Apple stock the day he came back. It was one of the best investments. A year later, I sold it because I'd made 100%. I would not be sitting here. I would be in your guys' seats, retired, if I had held on to that. So the term really matters. And also the term the other direction. If things aren't going well, what do you do with it? And what's the signal that causes you to decide when you're going to get out of the position or continue with the position, right? Elections are essentially just another bit of noise. Why? The main driver of stock returns on a forward-looking basis is earnings growth. That's it, right? There's other things that matter, but really that's what it is. That's the reason why the US stocks have done better than non-US stocks on a backward-looking basis. I have no idea what earnings growth will look like going forward, but that is what really drives the stock market. Now, asset allocation, or what we call strategic asset allocation, is probably the most important thing. And when they set up your portfolio, it's based on long-term, not 1 year, long-term risk-reward trade-offs of the different investments. There's a lot going on. Our compliance loves to make sure we put a lot of stuff down below. Although I didn't read out the thing from earlier about I'm not making any advice. What you have here is these are looking at the range of calendar year returns between, all the way on the left is 100% US bond portfolio, and the right is 100% stock portfolio over the last 100 years, about 100 years. Why this is important. The black dots are the average calendar year return over the last 100 years. The range, the green bars up top, is the best you've ever done in any 1 year in those portfolios. Unfortunately, the gold or yellowish color is the worst that you've ever done. And what does an advisor do? An advisor first thinks about what's the return we need for you to achieve your goals. And there's obviously more complex versions of this, is just stocks and bonds, and figures out where that is. What's that required return you need to achieve your goal? And the range of returns, though, is why they need to understand your risk tolerance, both on your willingness and your ability to take risk. Those two things can be very different from one another. Obviously, when they don't align very well, that's a difficult client, right? They might have the ability to take risk, don't have the willingness, but don't have the ability to take risk. What happens to this range? If instead I were to show you, this is the range of 1 year returns. If I were to show you the range of 3 year returns, and then 5 year returns, and 10 year returns, and 20 year returns, what eventually happens? The range of annualized return shrinks, and eventually shrinks to the black dots, right? So this is inherently the difficulty for an advisor or for investors. The dot is tied to your goals. The range of returns is why coaching a lot of times is necessary in understanding the risk tolerance of a client. Even more crazy, and this really ties to some of the questions. I can barely read it, and I'm this close, so I'll explain to you what you're seeing. These are taking all those calendar year returns for, on the left-hand side, bonds, on the bottom, stocks, and plotting the two against one another. So the return of bonds and the return of stocks, one dot is 1 year. Now, what's interesting here is the gold is the average return of stocks, which has actually been about 10% in the US over the last 100 years, plus or minus 2%, so between 8 and 12%. Only 6 times in the last 100 years has the actual stock market been between 8 and 12%. Right? Bonds are 5% plus or minus 2. So 3 to 7%. I think it's, what is it? 29, a few more, 20. So 30% of the time it's been between 3 and 7. The craziest thing is where we cross the 2 over. So the amount of years that you've had the average, you've had the return of the stock market and the return of the bond market, been the average plus or minus 2 years? Twice. And the last time was 1968. Right? So you want that average. You're expecting that average. You're probably not getting the average. Over a long period of time, you get the average, but definitely not in individual calendar years. Now, what happens then is diversification. Diversification smooths the ride, but it means that some things aren't doing well in the portfolio and some things are doing well. We generally hear 2 complaints from advisors. I love the diversified portfolio, but my client is pointing out the things that aren't doing well, right? And is also pointing to the things that are doing well and asking why we don't own more of it, right? But the diversified portfolio will never be at the top and never be at the bottom. Tries to smooth the ride along the way. You can go multiple years with those things at the bottom, staying at the bottom, but the reason they're in the portfolio is eventually to smooth the ride that you're going to experience, and which ties better to helping coach your clients. Now, it doesn't mean your portfolio won't lose money in a given year. I'm assuming unless they were magicians, in 2022, your portfolio probably lost money, right? You have some years where both stocks and bonds make money. You have some years that stocks make money, bonds lose money, vice versa. And every once in a while, both of them lose money in the portfolio. But fortunately, that's a pretty rare event. Now, diversified portfolio is important because it ties to that required return. So with the little bell curve, that's the middle line through the middle. I asked, and no one admitted it, that you've never called and asked why we don't own something in the portfolio, et cetera. I call the desired returns, or when you do that, or you're thinking about your neighbor, your brother-in-law, or somebody you know who owns something that, of course, they're telling you they've made a lot of money. They never tell you about the things that have lost money, right? The more people reach for desired returns, whether or not it's cryptocurrency or meme stocks or whatever it is on the right-hand side, the higher the likelihood at some point or another, they end up on the left-hand side of this distribution. And they end up increasing the probability that they don't meet their required returns to achieve their goals. Think of it, the more bets that they make. Okay. Now, the most important thing your advisor does for you is keep you invested. We've done all kinds of research on this, and this is COVID. The bottom of the market in 2020, if you'd stayed invested in a 60-40 portfolio through the end of last year, you'd have about a 24% return. If you didn't listen to your advisor and you bailed on the market and you'd gone to 100% bonds, you lost 23%. That difference between that, about 47%, you're not making it back, right? And what we call this, especially when I talk to advisors, call it the lifetime of fees that they're charging their client. Now, they can't tell you this. I can, right? They keeping you invested, all the potential stock that might outperform this or that, a little bet this way or that way, those don't matter. This is what matters, right? This is what matters to being successful. Now, success is easier achieved by setting goals and setting reasonable expectation. I mentioned earlier, the goal for an advisor is to be proactive in helping you understand to ignore the volatility and the noise like we're going to see in 2 weeks. Now, you can move to another country or another state. That you can do if you'd like. But there's always that need to be proactive. There's a need to be proactive because, as I said, you'll need to be reactive. I think a great example of this, about a year and a half ago, I went to a conference and Tom Brady was the keynote speaker. Now, I'm from Philadelphia, so I'm not a big fan. But I thought his presentation was quite good. And he talked about preparation. And what he talked about was, I don't know, 15 years ago or so, his coach at the time, Bill Belichick, had the commander of SEAL Team 6 come in and talk to the team about preparation. And what he said, the commander of SEAL Team 6 said was, we train and train and train, knowing 5 to 10% of the things we're going to experience, we could never plan for, no matter how much we train. But we still train so hard because when that 5 to 10% of things happen, the other 85 to 90% is that we need to do, those things become second nature. And it's the same thing as your advisors talking to you, proactive, the market's going to be volatile. There's going to be things you're going to be nervous about. They're going to affect you. So that when those things that really, truly you need to be reactive to, the unfortunate things in life, that all the effort and work is spent on making sure you're successful through those things. So with that, I thank you all, and I'm happy if we have time to take questions.
We could probably take 2, maybe 3 questions if anybody has any for Chris. What? Nothing. Well, I think, I really love this presentation.
You're welcome.
I loved it because it gave you the quantitative foundation behind, it gave you the math behind these concepts of stay invested. You see this in advertising all over the place, but it's Vanguard that's done the research to show you what's the math behind it. You know, that one bad day you have in one twitch, I'm going to get rid of my investments, or I'm worried about the election, can completely impair your future. And Vanguard's done the research year after year to show, on average, to what extent would that occur. So I think this is a great presentation. I'm really gratified, and I learned a lot from the presentation that I didn't know the exact numbers behind. So
you're welcome. Yes, sir.
So I don't know how much you paid, but we're not all of his clients aren't here, but did not see any hands for calls and panicking or whatnot. I mean, how common is that?
Not very. I mean, you can look and you can see through cash flows. Right? You can see where people bail out of the market and when they bail out of the market. Now, what is interesting we've seen is you look at the tech bubble or the financial crisis, there was definitely a lot more panic than we've seen over events over the last year, like COVID. What we really believe is that just people are seeking out advice more. And so they're being coached. There's a little bit of a combination of from advisor. There's also products out there, like in retirement vehicles, like target date funds and things like that, that naturally do the rebalancing versus someone in an old 401k who would look at it, didn't know what to do, got no advice, and would bail. You know, oh my gosh, I bail, and no one's managing that at all. Target date funds have seemed to control that. Same with people using advisors.
Anybody know what we're doing when markets drop precipitously, like in March of 2022 or 2020?
It's just should
And we may be making sales, but anybody know why we might be doing that? Yeah.
So you can have some cash to buy some bargains that are.
Yeah, but even more, especially in one type of account, taxable accounts, non-qualified accounts that are not tax deferred accounts. We're doing it to capture losses in your account for tax benefit purposes. We're capturing capital losses and stockpiling them for you so that you can use them going forward in the future. If there's ever a time where we want to recognize a gain that would be taxable, we have losses that we can pair them against. If you need cash later on and the only place we can get it is from a position that is appreciated, we can use that stockpile of losses, or you sell a house at a profit or some other asset. And so we don't mind when the market drops precipitously. We will take losses where doesn't mean we can do it in every client's account or in every position, but we will take those losses and then usually immediately put you into something that's similar to what we had you invested in so that you're not out of the market. And in the blink of an eye, we have captured for you tax benefits that can be very substantial. We have probably provided for clients millions and millions of dollars in tax loss benefits. Yeah, John.
How long can you sort of stockpile a loss like that?
As of now, forever.
The CPA.
As of now, forever. There definitely is a proposal to make that not like so that you can't carry it forward forever, right? That would be one of the tax. And we get the potential people, all the things that are behind the scenes of potential tax changes and regulation change. It's, I mean, pages and pages and pages. And that's why reacting to any of those things till they're a law and what they'll actually look like is a fool's errand. Yes, ma'am.
What Chris's presentation did was support what you've talked about in the past, which is the alpha and beta thing and chasing alpha and why we don't want to do that.
Yep.
Yeah.
Okay.
Repeat the
question.
Oh, repeat the question. So Melanie asked about alpha and beta, not to get too technical too quickly, but a market has a return, a diversified market, you might think of its return as the beta return. And if you've heard of hedge funds or active management, they're attempting to beat the market. And so if you can beat the market, the difference between the market beating return and the market return is called alpha, right?
And I'll add a great piece to this, and it was our founder, Mr. Bogle, who talked about this a lot, as well as some others, is whatever the market is, that's the market beta. For every dollar that outperforms the market, there has to be a dollar that underperforms the market, right?
Negative beta.
Think about this. If I were to ask you guys, are you guys all above average drivers? Right? A majority of you guys are going to say yes, but that would be impossible within this group of people. Same exact thing. Active managers all say that they're going to beat the market. On average, half of them before fees have to underperform the market on a percentage basis when you kind of sum that
It's
all
what
up.
we call a zero-sum game.
That's it. Yes, sir.
For such a long history of, showing stocks outperforming bonds, why is it we don't take on a little more risk? You see the 60-40 kind of average, why not 70?
100. Most people, even when they create target date funds, so for a 25-year-old, it would say own 100% stock. They don't need the money for 40 years. Even that, they put in usually 10% bonds to dampen. Most people can't deal with the volatility. And think about this. You start out, I don't know, I'll just make 30 years old, you have $100,000 in your account, you're 100% equity, you lose 50%, you're at $50,000. You might not care, you're going to work another 40 years, it might not matter. You fast forward to you're 40 years old and you got $2 million. If you're 100% equity and you lose half of that, let's say that we've seen a couple times and you're all in equity, you have $1 million. You're probably panicking a little bit more. You don't have as much of your work life left. You're 60 years old and you got $5 million. You're even more worried because there's a bigger dollar consequence. The dollars people don't talk about enough. The dollars and seeing the dollar loss versus the percentage. There's a big behavioral reaction to the dollar loss as you get older and older and realize you can't make the money back, or it's not as easy to make the money back from your human capital. And what you're going to
Did anybody notice the number I put in my introductory remarks? Anybody bother to read those introductory remarks? You haven't, then you don't have to, but you might. And I talk about how much money we have distributed since New Capital began. What's that number? $330 million we've had to distribute when people have needed money.
331.
331.
I thought you were paying me.
You got it right there.
Yeah, there, nice. All right.
And we don't pay them, but somebody asked that. So
There's
we
a lot of nerves about this election.
Yeah.
100%.
Is there a case to protect yourself for that?
No. So what I will tell you, the data shows that plus or minus 60 days of the election, the market's more volatile. That's volatility isn't just talking about downside volatility, it's upside. And if you actually, it's slightly, and I mean the difference between the 60-day return around the election historically over the last 100 years and all other time periods, the difference is 0.1%. And the only reason it's 0.1% lower during those 60 days is really 2008. And if you were to say 2008 had zero to do with any election whatsoever, it was a financial crisis. You remove that, the 60 days around the election were actually better returns historically than other times. And some of you look older than me, so you've been through time periods that were more volatile, say the late 60s with elections. We've definitely had other times. You go back, you think of World War II. I mean, you just go through periods of time where we've had volatile elections. It really doesn't, it may be one day. I mean, I remember Donald Trump in 2016. I remember waking up at 2 o'clock in the morning and the futures market was down, the Dow was down 1,000 points. We ended up positive on the day, right? The difficulty in figuring out what will actually be the impact might affect you personally. Don't get me wrong. My wife is losing her mind over the election. I choose to ignore things, right? But it has nothing to do with our investment portfolio, nor will it have with you. The worst decision you make is making.
I want to echo exactly what Chris just said, and then we're going to move on because JC and I are going to go into our presentation immediately. There may be things that, whatever the results of the election are, you want to change. You may want to change what you're doing, or you may want to change who you're talking to, or you may want to change where you live. You may want to even change where you keep your assets in custody. But the likelihood is that there's no change. I'm not saying there's no change, that there's any sort of gargantuan change that we're going to make to your portfolio is highly unlikely. That and Chris's talk shows you why we're unlikely to make that change. There may be changes, but unlikely that the portfolio will be the place that we want you to make the change. Or we'll be, I will be happy to talk with you about any change you want to make, how to afford it, how to finance it, when to do it, et cetera, et cetera. We can capture that. JC and I can work with you in financial planning. I'm not saying there aren't financial aspects to the election and to the results of the election. We're just saying, because of Chris's presentation, the portfolio is the least likely place that we're going to make massive changes to it because of the nature of securities prices and portfolios and returns. That make sense?
And one last thing, my sister Stacy, so I'll check with you. Means a job.
Have Stacy give us a call.
Yes.